The greatest stock investor alive spent 3 years selling stocks, not trimming, not rebalancing, selling. $134 billion in equities unloaded in 2024 alone, $172 billion net sold across the 3 years before that, all while the S&P 500 climbed over 20% for 2 consecutive years. And analysts on television told you the bull market had nowhere to go but up. By late 2025, Berkshire Hathaway was sitting on $381 billion in cash, not invested in companies, not deployed into the market, just sitting there in US Treasury bills, earning interest, waiting. That cash pile is larger than the entire GDP of South Africa. It is the single largest corporate cash reserve in the history of American business, and the man who built it spent months publicly refusing to explain why. So here is the question that nobody on financial television will ask directly. When the person widely considered the best capital allocator of the 20th century quietly moves $381 billion to the sidelines, what does he know? This is not a story about a billionaire's portfolio decisions. You don't have $381 billion. Neither do I. But this story is about you. Every time you check your 401k, every time you're told to stay invested for the long term, every pension fund, every index fund, every retirement account in the developed world is built on one foundational assumption: that the market goes up over time, and that the best strategy for ordinary people is to stay in, always. Buffett himself built that belief. He told you stocks beat everything over the long run. He called market timing a fool's errand. He said the right hold period for a great company was forever. So when that man, specifically that man, spends 12 consecutive quarters selling more than he buys, the longest net selling streak of his entire career at Berkshire, you are owed an explanation. Not because he owes you one personally, but because the framework you've been sold for your entire financial life was built partly on his authority. What he did in 2023 and 2024 is either the biggest mistake of his career or a warning most people will understand only after it's too late. Here is the official story, the one that's technically true, the one that Wall Street analysts gave you. Buffett is a value investor. He buys companies when they're cheap and holds them until they're not. His core principle, the one he inherited from Benjamin Graham in the 1950s, is that every stock has an intrinsic value, a real price, based on what the business actually earns. And the market price drifts above and below that real price, depending on fear, greed, and whatever narrative is dominating the news cycle. A value investor waits, then buys when the price falls below the real value, then holds until the market catches up. By that logic, what Buffett did is simple. He looked at the market in 2023 and 2024, saw that prices were high relative to earnings, and decided there was nothing worth buying at those prices. So he sold what had become overvalued, Apple most dramatically, down from 915 million shares to roughly 300 million, and waited for better opportunities. That explains the cash. The market was expensive. He couldn't find bargains, so he accumulated dry powder. This is the explanation Buffett himself offered in part at the 2024 annual shareholder meeting. He called it patient capital allocation. He reminded everyone that Berkshire would always remain predominantly in equities. He said he still loved stocks. The data appears to support the surface story. By late 2024, the S&P 500 Shiller-Cape ratio, a measure of market valuations that smooths earnings over 10 years, had reached 37. Its historical long-run average is around 17. Stocks were, by that measure, more than twice as expensive as their historical norm. So the conventional explanation is old investor, disciplined methodology, expensive market, rational caution. Nothing to see here. But here's where the story gets complicated. Because if this were simply about overvaluation, you'd expect Buffett to gradually redeploy the cash when prices corrected. He didn't. When the market dropped sharply in early 2025, when prices fell and bargains theoretically appeared, Berkshire kept accumulating cash. The pile grew from $334 billion to $344 billion to $373 billion. He didn't buy the dip, not even close. Think about a fire station. A fire station doesn't build up its water supply because it expects a small fire. It builds up its water supply because it expects a fire large enough to overwhelm whatever it has right now. The bigger the reserve, the bigger the fire someone is preparing for. Apply that directly to Berkshire. $381 billion is not the market seems a bit pricey reserve. $381 billion, accumulated through systematic, relentless selling over 3 years, is a "I need to be able to act at a scale that will matter" reserve. It is preparation for an opportunity so large that Buffett could not have seized it with the resources he had in 2022. Now look at the specific numbers more carefully. By the end of 2025, Berkshire's cash position actually exceeded the value of its entire stock portfolio, $373 billion in cash, roughly $300 billion in equities. This is not a defensive posture within a normal portfolio. This is a complete inversion of his operating model for 60 years. For the first time in his career, Buffett held more cash than stocks. And this is where Buffett's own metric becomes the evidence against him. For 20 years, he cited the ratio of total U.S. stock market value to GDP, a measure now known as the Buffett Indicator, as, in his own words, probably the best single measure of where valuations stand at any given moment. He wrote that in Fortune magazine in 2001. By October 2025, that indicator had reached 219% to 224%. Its historical fair value range is 90% to 135%. Buffett himself said that levels exceeding 200% meant investors were playing with fire. So the man who invented the best valuation metric watched that metric exceed his own danger threshold by more than 80 percentage points. And then he quietly moved $381 billion to the sidelines, without giving a press conference, without a public warning, without a single alarming statement. He just did it in the regulatory filings every quarter, while television commentators told you to stay the course. Nobody reports on this in the way it deserves, not because it's hidden, because it's obvious once you know where to look. But this raises an even more uncomfortable question. If the market being expensive explains the selling, why didn't he buy when the market fell? And why did the selling accelerate at exactly the same time he was preparing to hand the company to someone else? There are three separate explanations for what Buffett did. All three are probably true simultaneously. That is what makes this uncomfortable. The first is valuation. The Shiller-Cape ratio at 40 is its second highest level in recorded history. The only time it was higher was the peak of the dot-com bubble in 1999 and 2000, when it reached 44.2. The S&P 500 then fell 50% over the following 2 years. Buffett was selling Apple when Apple was trading at nearly 30 times forward earnings. He bought it in 2016 when it traded at 10 to 12 times earnings. He tripled the valuation multiple. He sold. That is not fear. That is arithmetic. The second explanation is taxes. Buffett said it himself at the 2024 shareholder meeting. He suggested that capital gains tax rates might rise as the U.S. government attempted to fund a ballooning fiscal deficit. Paying the taxes now, he told shareholders, doesn't bother me in the least. This is the least dramatic explanation. It is also the most rational. Locking in gains at a 21% federal rate before a potential future rate of 28% or 30% is simply good accounting. Over $134 billion in equity sales, the difference in tax rates is worth tens of billions of dollars. The third explanation is succession. On May 3, 2025, at the annual shareholder meeting in Omaha, Buffett announced that Greg Abel would become CEO of Berkshire Hathaway, effective January 1, 2026. He had been building to this for years, but here is the detail that changes the interpretation of the cash pile. $381 billion is not a defensive position. It is a gift. Buffett is handing his successor the single largest war chest in the history of corporate finance. He is giving Greg Abel the ability to deploy capital at a scale and speed that Buffett himself never could, because previous versions of Berkshire never had resources at this level. If markets correct sharply in 2026 or 2027, if the Buffett Indicator returns toward its historical average, Berkshire will be positioned to buy assets at prices and quantities that define the next generation of the company. Think about what that means for you. Buffett spent 3 years telling you the market was fine, that he still loved stocks, that Berkshire would always be predominantly in equities, while simultaneously building the largest cash reserve in corporate history. Both things were technically true. Neither told you what he was actually doing. The system did not fail here. The system worked exactly as designed. Quarterly filings are public. The cash position was reported accurately. Every number was disclosed. But the system is built on the assumption that ordinary investors will not read 10K filings, that they will rely on television anchors to interpret the news. that by the time the interpretation reaches them, the positioning will already be complete. In 2024, while Berkshire sold $134 billion in equities, retail investors poured money into the market at record rates. Individual investors bought the same stocks Buffett was selling, not because they were wrong to trust the market, but because the information was structured to reach them after the positions were already set. At the start of this, the paradox was, the greatest stock investor of his era stopped buying stocks. Now you know the resolution is more complicated than that. He didn't stop believing in stocks. He stopped believing the stocks available to him were priced at levels worth owning. There is a difference, and that difference, that gap between stocks are good and these prices are good, is where most ordinary investors live permanently, because nobody in the financial media has an incentive to explain it clearly. The final number you should sit with, the Buffett Indicator, the metric Buffett himself called the best single measure of market valuation, stood at 219% in March 2026. Its historical average is roughly 100%. That gap, 119 percentage points above average, represents the distance between what the market thinks assets are worth and what economic output suggests they are worth. Someone will close that gap. Either earnings grow to justify the prices, or prices fall to match the earnings. One of those outcomes is celebrated on financial television. The other is called a crash. Buffett didn't sell everything. He sold $172 billion in equities across 3 years and kept $300 billion in stocks. He just made sure he had $381 billion ready for the moment when everybody else was selling too. That is not panic. That is preparation. The only question is what he was preparing for, and whether you'll understand the answer before or after the fact.